And the issue is that this is the third increase in a row from the PPI, and it's also much higher than expected. And so the reality is that all these companies out there are in it to make money. And if their costs are going up, they're going to pass it on to the consumer. We already know the consumer is struggling with debt. They're struggling with inflation. And even if inflation has come down over the last 12 months on paper, the reality is that people are still paying 30 to 40% more than they were 2 to 3 years ago.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are watching and listening to the Financial Survival Network. I'm your host, Kerry Lutz. Hey, it's 10:11. I always like those dates where they go in numerical order. I don't know what to make of it, but we did get our PPI numbers out today. And does it mean the Fed's going to stop tightening or tighten some more? What is going to be the upshot of these numbers? Well, Eddy Gifford's with us now, tactivewealth.com/Eddy Giffords, Eddy Gifford. And hey, just take a look at the site. If you got a question or comment, shoot me an email, kl@kerrylutz.com. Eddy, great to have you back. So should we be happy about the PPI or should we be feeling bad about it?
Well, the initial response from the bond market seems to be happy. Our markets in general opened up today, but they appear to be kind of fading. And the issue is that this is the third increase in a row from the PPI, and it's also much higher than expected. And so the reality is that all these companies out there are in it to make money. And if their costs are going up, they're going to pass it on to the consumer. We already know the consumer is struggling with debt. They're struggling with inflation. And even if inflation has come down over the last 12 months on paper, the reality is that people are still paying 30 to 40% more than they were 2 to 3 years ago. And so that's starting to affect the pocketbook. And the fact that the Fed has continuously raised rates and tells us that they think that they're sufficiently restrictive and PPI is going up, I think that it really puts the Fed in a precarious situation. Powell has told us time and time again that, hey, inflation, he's going to fight it no matter what it takes. And we're going to see if that holds true because things are starting to crack, things are starting to break, and now we're seeing inflation start to rise again. So I think that, it would be smart to be a little bit uncomfortable right now.
Well, the one number that supposedly the Fed is pegging to its interest rate policy is the 2-year Treasury rate vis-a-vis the Fed funds rate. Right now, the Fed's fund rate's 5.25, 5.50. The 2-year Treasury has dipped below 5% at 4.997. Call it 5%. So they've still got a little bit of breathing room there, don't they?
They've got a little bit. I mean, when you looked at the bond market last Friday, you almost saw the yield curve kind of re-invert or opposite of invert, right? We were super, super close to the 10-year yield actually going higher than the 2-year. Typically, when that happens, that's kind of the start of things getting really bad. The warning sign is when the yield curve is inverted, but usually the catalyst is when that thing kind of flips back. And so that got close on Friday, didn't quite happen, but now we're sitting in this scenario where, yeah, you're right. There's a little bit of breathing room there. If they're looking to the bond market, they're probably saying, hey, we can wait another month. But if they're looking at inflation numbers, we'll see CPI tomorrow, but if looking at inflation numbers, they might be like, we got to get ahead of this thing. So it's the same song and dance. We're in this very, very unknown situation. Markets have rallied this year, but if we're looking at true returns net of inflation over the last couple of years, we're not doing that good.
Yeah, exactly. All right. So from the individual investor, from your standpoint, how do you play this trend of, uncertainty, not knowing, the old the old Maxim 60-40 portfolio, buy and hold till you die, all that stuff does not apply anymore, does it?
I definitely don't think so. I think that the passive investor in the 60-40 buy and hold scenario is in for a rude awakening, unfortunately, over the next 3, 5, 10 years. Active really shows its prowess when you have things like a lost decade like we had from 2000 to 2010, and things are lining up very, very similarly to that right now. So, I think that the main thing is you need to maintain flexibility. You need to be able to, admit when you're wrong, so to speak, cut your losses and move into something else. And at least right now, you can actually get paid to wait, right? You had mentioned Fed funds rates at 5.25. Money markets are paying anywhere from 5.25 to 5.4. Some ETFs backed by treasuries are paying 5.5, 5.6. So there's definitely opportunities to kind of take advantage of just playing the wait and see game. Of course, the downfall to wait and see is when you get back in, right? And so as long as you have a disciplined strategy that is rules based, that says, hey, this is when I get in, this is when I get out, there's no problem with kind of sitting on the sidelines, so to speak. So and then you just got to lean in. When the trend is in your favor, lean in and just make sure that you're cutting your losses or implementing stops and targets, so that if you're right, you're locking in profits on the way up, and if you're wrong, that's okay. We're going to get out of there, put it in cash or put it in treasuries, and then short-term treasuries, and then find another thing to buy. If it's out there, right? I mean, things definitely don't look as exciting as they did 4 months ago. And I think that that's just because there's a lot of cracks under the surface. And, we've seen kind of a flight to safety start to materialize with long bonds, but we don't know how much of that is we think that the rate rising is over, or we think that this war is going to last longer than anyone wants to admit, or that we think that something is actually broken and we just don't know what it is yet.
So how many wars do you think, we got 2 wars going on, hot wars right now.
Right.
That could easily turn into 3 or 4 more wars, couldn't it?
It could. I mean, the geopolitical mess that we're in right now, and the fact that everyone is struggling, because that's the reality, right? Everybody all across the world, this is the inflation thing, that the overpriced housing thing, everything that's going on right now, it's not just a US thing, it's a global thing. And if any of you have any family, or if you're married, or if you have kids, you know that the one thing that stresses you out more than anything else is when the money's not there, right? And that's kind of what the governments all over the world are running into, right? So what's the solution? Well, let's fight, right? And let's, because at least if we have the most money out of everybody else because we take over everybody else, then we're still on top, right? It doesn't mean that's good for anybody at all, but it definitely serves as a catalyst to where maybe if we wouldn't have jumped into a conflict 3 years ago, we might today. And that's the thing that's scary about what's going on right now.
Yeah, well, it's a scary world out there, let's face it. And hey, what can you do about it? It's everything's kind of going crazy. But hey, we haven't talked about this before much, but China, it seems to be imploding faster than the rest of the world. So I guess that makes them the trendsetter, right?
Well, China's been the growth leader for a long time. So, just like stocks in general, usually the one that's the front runner is the one that falls first, and everything follows. So, their real estate is a mess. And there's a lot more things that are a mess out there. And they've become such a big global player that to think that that's not going to have effect on everybody else is just silly. There's the China is one of the main economies in the world. They made it obvious and apparent that they want to be number one. And if they're getting beat up, then that's going to affect everybody. And there's a driver behind a lot of technology supply. So it's getting dangerous out there again. We could see if China really implodes, we could see that really, really affect every market. And a lot of the semiconductor market, which has done amazing this year. So you definitely need a life raft right now. You definitely got to make sure you have a parachute in place. The problem is that the parachute doesn't appear to be bonds anymore. So that's where it's it's fun for me because as a financial advisor and as a numbers guy in general, like I love finding the opportunities. But it's a very, very stressful time, especially if you're sitting there looking at your 401k and you're about to retire and you've seen that your bonds are down 30-40% over the last 2 years, and those are supposed to be the safe things.
Yeah, if that's safe, then what's risky, right?
Exactly. So that's the that's the danger of any time that you become too complacent with any type of strategy, whether it's buy and hold or anything. Like the moment that you stop trying to refine and improve is the moment that you're going to fall behind. And I think that there's been a lot of complacency in buy and hold because we've had zero interest rates for so long, and that's been so good for equities. But I think that's going to flip. And, if you're not ready, you're going to be another statistic or sad story. And, we aim to just help people avoid that or at least protect themselves against something like that.
So you sell your house now, take your profit when you can get it?
If I own investment property right now, I would probably, even though rates have been so low, I would probably be liquidating because I think we're in a scenario where liquidity is key. If things do go down big, that's going to give you a lot of capital on the sidelines to buy stuff that's on sale. When markets go down, that's not a bad thing. That's normal, right? I mean, if we look back over the next 20 years, you and I are probably going to see 2, maybe 3 times where the market's down anywhere from 35 to 50%, because that just happens, and so the question is, how do you react to that? And how do you protect more capital on the way down without just completely eliminating your upside if you're way early to the party? So, a home is different than a rental. So, if you live somewhere, the reality is you're probably in a fixed rate mortgage and your housing expense is not that high relative to what's going on out there. But in investment real estate land, commercial real estate land, I would be liquidating, and that would be, I would make sure that I have the same mentality when it comes to equities in general, by implementing stops and targets. So it's all about discipline and maintaining a strategy and sticking to it. And that's very, very hard, especially in moments like this, because when you and I look at something, we might be like, oh my gosh, the world's going to end. That doesn't mean the stock market's going down, right? Sometimes it can mean the opposite. So we have to maintain that discipline, even if we are very pessimistic on what's going on big picture.
Right. All right. Yeah, like they say, the market can remain irrational for longer than you can remain solvent, right?
Exactly. So have a plan that takes advantage of those emotions.
All right. Well, Eddy, we always appreciate you coming on, giving us your very insightful perspective on the markets and on investing. People want to connect with you. Where do you go again?
Yeah, so just tactivewealth.com/Eddy Gifford. You could just look up Eddy Gifford Tactive on Google, and it'll take you right to my page. And yeah, I mean, I love helping people. That's why I'm in this business, and that's why I'm talking to you. So,
all right,
anyone's interested, I'm here.
All right, hey, we appreciate you coming on as always. Got a question for Eddy and myself? Email kl@kerrylutz.com. Hey, make sure if you're watching this on YouTube, you like, share, and subscribe, and go to our site, financialsurvivalnetwork.com. Sign up for your free newsletter. Hey, Eddy, appreciate it. We'll talk to you again real soon.
Thank you.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.